Today we're going to analyze Whirlpool Corporation. Basically, Whirlpool, they just sell um, dishwashers and like appliances and washers and dryers. So a lot of stuff that you might use every day, basically just appliances. They also sell refrigerators. So yeah. Okay. 5-year chart. They are minus 10% over the past 5 years. They popped off right after COVID, and then it's been a slow grind down. And let's see exactly why. Okay, their market cap is 6.5 billion and their price to earnings ratio is 13, so actually not bad. And let's see like kind of where they're at with their numbers. They had a bad year in 2022 for some reason, but it looks like their profit margin otherwise has hovered about 5 to 6%. Here they had 8% margin and then negative margin, and last year they only did 2.5% margin, so not the greatest margin, just 2.5%, but they still have a price to earnings ratio of 13. So it kind of looks like this might be undervalued at this point, but let's see. Let's check out their statements and their 2017 and going to 2023, their revenue actually declined slightly. So maybe like minus 1% a year, or like maybe like minus 0.5% a year. So they didn't, yeah, their revenue declined, but not by much. In terms of gross profit, their gross profit actually kind of followed their revenue pretty closely. And yeah, it looks like the reason why they had a negative earnings in 2022 is because of unusual expense. Yeah, non-operating interest expense. That's why their income went negative. Probably has to do with rising interest rates, if I had to guess. And yeah, 1 billion in income. If they can do it, if they can have a good year, it's 1 billion in income. Now, the thing that's bad about this company, I looked at it before, and they have a lot of debt. A lot of debt. They have 6 billion in debt, and if you remember, the value of the entire company is 6 billion. So, yeah, so they have as much debt as the company is worth currently. So their debt pile is pretty massive. And it's going to affect the DCF model that we're going to do at the end. So don't worry, we're going to check that out as well. In terms of cash flow, looks like they are trying to pay back some of the debt, but not a lot. They took out 2.5 billion last year in debt, and they didn't really buy back any stock. They're paying out some dividends, so that's at least good to see. In terms of stats, their return on invested capital is like, I don't know, 6-7%. Follows pretty close with their net margin. And let's check out the analyst estimates here. Analyst estimate for 1351 next year, and then the year after is 1464, maybe like an 8% increase. And then the revenue estimate is 17 billion and going down to 17 billion. It's basically flat. That is the analyst estimates for revenue. Let's plug this into the DCF model. Now, the thing about this company is it really has to do with margins. So we're going to be using this revenue margins calculator right here. And we're assuming 0% growth in revenue because that's what the analysts are saying. And it makes a lot of sense to me. So we're going with 0% revenue growth. And in terms of profit margin last year, they did what, like 3%? And yeah, I'm hoping that they can get back up to 4, 5, and 6%. 6% is what they do on a normal year, I think. So that's what we're thinking. They're going to get back up to 6% margin, and in this case, then their fair share price is $109, which is lower than their current price. But that is because of their debt. Now, if you think that debt is like not as bad as, because you really only have to pay interest on it, and as long as you're making more money than the interest is, then it's fine to have it. So probably their fair share price is in between this between $109 and $224. And that's if this scenario plays out where they get up to 6% margins. It's definitely possible that they stay at like 4% margins. And if they stay at 4% margins, then yeah, then the fair share price is between 40 and 155. So at least like if you ignore the debt, then they still have a fair share price that's above their current trading price. And a definitely 4% margin is for sure doable for this company. I do expect them to get back up to 6% margin at some point. And in that case, there's not a lot of downside with this stock. So it's not the worst stock in the world, but there are a lot of risks. So that's why I'm personally staying away. But it's kind of like a high risk, high reward type of stock. Not something that I would be opposed to holding in any portfolio, especially since you could probably expect like a 10% return as long as you're getting an X multiple of 15, which is totally fair for this business. Yeah, high risk, high reward. I think 10%. You might even be able to do better than that if they get any revenue growth at all, and maybe their profit margin gets up to like 8%. I mean, nobody really knows. So yeah, but otherwise, yeah, you could maybe expect even higher than 10% returns if debt's not really an issue. And yeah, that's my analysis for Whirlpool. If you guys have any questions, make sure to leave them in the comments and I will answer them. Otherwise, I do leave a link in the description for the spreadsheet so that you guys can try it out yourself. You can use it for any company. Companies just load up in here. You just have to change the boxes with the yellow. And yeah, hit that like button, and I'll see you in the next video.